The three types of assets that are available for you to grow your money. The first, the reason why crypto, or what I like to call shitcoins, has done so well is because it's purely speculative. So we're gonna move this crypto, shitcoin. We go to F, fail. The whole idea of investing is to outperform inflation. And so a term deposit won't do that. All right, so the next asset is the one that almost everybody hangs their hat on. So here's what I'm gonna do. We're gonna rank the worst to the best assets to grow your wealth. Buckle up. I'm Lloyd James Ross, seven-figure investor and entrepreneur, and I've helped thousands of business owners and professionals turn financial stress into success. If you're stuck in old money habits, overwhelmed by investing, or unsure where to start, this is for you. I'll give you the mindset and strategies to take control, grow your wealth, and achieve financial freedom. It's time to make your money work for you. You've been investing wrong and it's costing you more than you think. You sit there staring at your investment account, wondering why it's not growing the way you thought it would. You followed all the advice: buy, hold, dollar cost average, diversify, but somehow your portfolio just isn't delivering the wealth you imagined. And then frustration kicks in. See others talking about their wins, doubling their money, retiring early, and living stress-free. Meanwhile, you're stuck watching your investments crawl at a snail's pace, or worse, losing money. But deep down, you start questioning everything. Did I pick the wrong stocks? Should I have gone all in on crypto? Is real estate the answer? You read articles, watch YouTube videos, and even ask for advice. But the more you learn, the more confused you become. So you stay stuck, doing all the same things, expecting different results, while time slips away and your dreams of financial freedom remain just out of reach. The truth? You're not alone. Most people are investing wrong, not because they're lazy or careless, but because they were never taught the right way. And until you fix that, real wealth will always feel just beyond your grasp. Most people have no idea where to put their money for the best returns. They follow trends, chase hype, and end up disappointed. But if you actually look at the numbers over the last 30 years, the rankings might surprise you. Let's break it down, worst to best. Before I do that, I want to teach you three things. The three types of assets that are available for you to grow your money. The first is speculative. This means you have no idea what you're buying, and the only reason you're buying it is so it goes up. The second type is called non-productive assets, and these are things that don't necessarily produce anything. You can make money from them predictably, but they don't produce anything. And the third type is the best type. They're called productive assets, and they produce things while you sit there and watch them. And they're the type of assets that are gonna grow your money effectively, but most importantly, they're the ones that are gonna provide you with absolute financial independence because they produce cash flow, okay? So speculative, non-productive, and productive. So here's what I'm gonna do. We're gonna rank the worst to the best assets to grow your wealth. Buckle up. Stay to the end because I'm gonna keep the best one till last. You don't wanna miss it. So here we are, best and worst investments based on my own personal results and knowledge. It's not advice, it's just how I think I'd approach these assets. And hopefully it's gonna give you some knowledge so you can understand why I am doing this the way I am and how my brain works when it comes to investing, okay? So you can see I've ranked them S, A, B, C, D, F, and I'm gonna actually move them to the rank based on what I feel about them. The very first one, in my opinion, is the worst. And a lot of people are gonna disagree with me. That's great. I want you to question yourself. Are you a multimillionaire and do you have financial independence? If the answer is no, maybe listen up. And if the answer is yes, well, maybe do a YouTube clip and I can come and comment on yours. All right, so the very first one, coming in dead last, are what I like to call shitcoins. Yes, hyped up speculative assets, if you can call them that, that might skyrocket today but crash to zero tomorrow. You hear about people making millions overnight, but let's be real, those gains don't last. And if you want to gamble, you're better off going to the casino probably. But the reason why crypto, or what I like to call shitcoins, has done so well is because it's purely speculative, and so it can be bid up very quickly. But the only way to make money in that is to actually sell that asset to a greater fool. And it follows this thing called the greater fool theory, okay? Now, the greater fool theory suggests that when you buy an asset, the only way you can make money is if you sell it again to a greater fool. The problem with that is it needs more people to buy it for it to go up in value. And that's why they call it a Ponzi, because it requires more people to join the network for it to go up. And that's almost identical to a Ponzi scheme. So you think about how you're going to make money. It's very speculative. It's a guess because you don't know what it's worth. And the reason you don't know what it's worth is because it doesn't produce income. So you can't discount it back using a simple formula to determine if you're getting a bargain or you're getting ripped off, right? It's like a hot potato. It's the hope diamond. It's like dancing as Cinderella at the ball and you know you're going to turn into a pumpkin at midnight, but there's no clocks in the room. No one knows when it's going to collapse. Does that make sense? So when it comes to Bitcoin, many investors fall into this trap. Unlike stocks, which generate earnings and real cash flow, and real estate, which creates rental income. Bitcoin doesn't produce anything. It's one of those really non-productive, speculative assets. Its price is purely based on supply and demand and speculation. People buy Bitcoin because it has no intrinsic value, but because they believe someone else will pay more for it in the future, which is why Bitcoin is the absolute worst of the lot. Because the reality is, because it's got no intrinsic value, if you wind the clock forward 20 or 30 years, it probably won't be here. And people say, well, Lloyd, it's worth 100,000. I'm like, 100,000 or what? $100,000 in fiat currency, the very currency you think it's going to actually overtake, and you're measuring all your success in fiat currency, the number one currency you think it's going to overtake. What are you, crazy? It's ridiculous. You just want the fiat currency so you can buy a house and a Lambo. Am I wrong? All right, so we're going to move this crypto, shitcoin. We go to F, fail. Not a good asset, okay? You watch. And how I know that too is nobody who's wealthy in the world today has got there from purely investing in Bitcoin. Even Michael Saylor, who is the Bitcoin god, he has actually built a business, a SPAC, that's actually developed over time as a listed company to actually create wealth for him in fiat currency, okay? So moving on, what's the next one? Next up, we've got term deposits. If you love watching paint dry and getting returns that barely beat inflation, then this one is for you. Sure, they're safe, but when inflation is eating up 3 to 4% per year and you're only getting 3 to 4% per year back, you're not making a return at all. Without a doubt, they're safe and they do serve a purpose, because if you are looking to park your money for a period of time to just leave it there in cash, it is good in the sense that it can provide some return so your funds don't get gobbled up by inflation. But the reality is, because it's in a term deposit, the money itself can't grow beyond inflation, which means your money in the future is not going to be worth any more. The whole idea of investing is to outperform inflation. And so a term deposit won't do that. And I'm only using term deposits in Australia. If you go to America, the term deposits are like 0.5%. So how are you supposed to make money if inflation's at 3 or 4% and you're getting 0.5%? You're losing money in term deposits. It wasn't always that way. There was a time when term deposits were 15, 16%, but also inflation was running at 15 or 16%. So the reality is term deposits are just an inflation hedge. They're okay, they're certainly safe, but at the end of the day, they're not going to perform as best as possible for an asset. So what we're going to do with a term deposit, we're going to move a term deposit. I think a term deposit is better than Bitcoin. So I'm going to move this up here, because in the future, Bitcoin will go to zero because it's worthless. There's no intrinsic value. Whereas a term deposit, it'll protect your wealth. You'll keep your money. I've got a friend of mine. He's got about $600 million in interest-bearing deposit in a bank. Yes, $600 million. So if he can put $600 million and sleep soundly at night, it's going to be sensible to have it there to protect your wealth, but it won't grow it fast. So it's a really good place to store it until you find a better place for it. I'm a poet and didn't know it. Okay, so next one on the best and worst investments chart here. We're going to move on. We've got, which is very similar to term deposits actually, bonds. Bonds, what are bonds? Bonds are simply an IOU. You can have treasury bonds, which is where you're lending money to the government. You can have corporate bonds, which is where you're lending money to companies, and you can have municipal bonds where you're lending money to the municipality, right? There are different types of bonds. But bonds is basically when you're lending money. You lend the money, they give you a bond, which is a financial instrument, okay? Now, bonds, how they work is they actually produce a coupon or income to you. So when you lend money, you're getting paid interest from the person you're lending it to, okay? It's effectively money lending in a very structured manner. You can buy and sell bonds, 30-year bonds, 10-year bonds, 1-year bonds. In fact, right now, Warren Buffett, the wealthiest investor who's ever lived, in fact, right now he's ranked number 9 richest in the world, and he's been number 1 before. And he actually owns, right now, as I say this and record this, he's actually got $335 billion invested in bonds. Okay, so you're thinking to yourself, well, why has he got $330 billion more? He owns more bonds than the US government. Why is that? Because he's not ready yet to deploy the money into more productive assets. And in his letter to shareholders that just came out 2 days ago, he said he much prefers to put it into stocks than hold it in short-term bonds. But right now, he can't find anything effective to buy. So it tells me straight away that the market's overpriced in stocks. But when he finds something effective that matches his requirements, he'll take it from bonds and he'll put it into stocks. So he knows that stocks are better than bonds. So we can't put bonds up too high in the rankings of best and worst investments. But because bonds are really safe, treasury bonds, just so you know, are actually called risk-free assets. They're risk-free. Why? Because they're fully backed by the government, meaning you cannot lose because the government will just print money to give you back the interest on your bond. So treasury bonds are risk-free, which is what actually props them up higher on the chart. But the reality is they don't produce much. So like it might give you the same returns as a term deposit, okay? So it's very difficult to outperform inflation. And then the worst part about it too, similar to term deposits, is the income you're creating from those assets is fully taxable. Meaning you're gonna get 30% of your cash flow taken away from you by the government because interest income from bonds and term deposits is fully taxable. There's no tax relief, right? So that keeps them low on the chart. So we wanna put bonds, they're very safe, they're probably on par with term deposits, and we can put them there on the chart, okay? So they're a D because, yeah, they can serve a purpose for short-term cash needs for sure, but right now we're talking about growing your wealth. We might even put them up. I feel sorry for the bonds. We're going to put them up here. Hey, you can't knock the bonds too much. We'll put them to C, okay? All right, there you go, bonds. You can go to C. That's much better, all right? Because Warren Buffett owns a lot of you, so they're okay. All right, so the next asset is the one that almost everybody hangs their hat on, the one that most people love. If they could take it to bed and sleep with it, they would, especially in this country here in Australia. And it is none other than real estate, especially residential real estate in Sydney. But it's not always the way. It's not always the case, okay? Now, of course, real estate is a productive asset. How is it productive? It produces income from renting it out and land values go up. Why do land values go up? It's because they're not producing any more land. There's only a finite supply. They are producing more housing, so you can oversupply the housing market from construction, but land itself is where the value lies. So land goes up over time if there's population growth and limited supply of land, and also if there's a desirable place to live, right? But the reality is that it's not always going to go up. Little do people realize that it doesn't always go up. It's just gone up in the last few years, but it's definitely up there, one of the best assets you can own, without a doubt. So I'm going to move it up on the slide in a second, but I want to just explain something to you about real estate. In the book, Rate of Return of Everything from 1970, 2015 it was published, it indicates historically residential real estate has offered returns of about 7% a year, which is actually pretty good. Considering inflation is 3 or 4%, it does beat inflation. But unfortunately, people think that it produces 20% a year because that's what it's done over the last couple of years. But that's a recency bias in your head working against you. 7% is about what it takes to actually beat inflation. So long-term returns are about that. And here's the thing, there's a rule called the rule of 72. And how the rule of 72 works is you take the number 72, divide it by the annual return of an asset, and it'll tell you the number of years it's going to take for that asset to double in value, right? So if we take the rule of 72 and we divide it by 7% return, which is what real estate does, you can see it doubles every 10 years. That's where the real estate, Bible or prayer comes from. Real estate doubles every 10 years. That's like this paradigm that everyone's got in their head. It's because of the rule of 72, because it produces about 7% a year on average. Now, there are different types of real estate. You've got residential real estate, commercial real estate, industrial real estate, put call options, construction. You can renovate it. You can develop it. I mean, there's lots of things you can do. You can farm it. There's lots of things you can do real estate. So it's wonderfully flexible, right? So residential real estate is returned about 7% a year on average, and commercial real estate's return a lot more, but commercial real estate is far more risky because you actually got a business who's the tenant, and you can't always find effective tenants for commercial real estate, right? I remember this property that we once owned that the tenant legged it and left, and all of a sudden you've got to pay the body corporate fees, you've got to pay the bank, the mortgage, because the business went broke. So you've got to be very careful you don't own commercial real estate without understanding it fully. And certainly with residential, it's a lot more simple because everyone needs a place to live because they need shelter, right? It's a very basic human need. So it's a very, very popular asset for people to leverage and use. So it's very good for the community, right? Like we need housing. So that's why it's never gonna go out of fashion. Okay, so now we're gonna rank real estate. But before I do that, where are the rankings sitting? Firstly, we got shitcoin at F, we got term deposit at D, and we've got our bonds sitting at C. So where does real estate rank on this scale? Let's move it up here. We're gonna put it up to B. Yep, I think it's a wonderful asset class, and if it was a little bit more undervalued, I would buy it in spades. In fact, during the GFC, I was offered to buy apartments in Surfers Paradise here, which is a very popular place to live in Australia. Get this, ready? I was offered to buy apartments in Surfers Paradise for $50,000. Can you believe that? So I've actually seen real estate go down as well as up, and it will do that because if you look at different markets at the moment, you look at China, real estate's dropping and falling. You look at Japan, real estate in Japan hasn't grown since 1991. It's 35 years of no growth, or 33 years of no growth. It's gone down. And people are like, it always goes up. No, it doesn't. Japan hasn't gone up for 30 years. It's gone down. China's gone down. And guess what happened in the United States after 2008? If you haven't seen The Big Short, the movie, which is one of the best movies ever when it comes to money, go watch it. Real estate fell after 2008 when they realized that strippers were buying 5 homes at a time with ninja loans. No income, no job, no stability, okay? So it doesn't always go up. And right now there's a massive bubble in Australia. You can buy a French chateau castle with 35 bedrooms for 1.7 million euros, or you can buy a shitty 4-bedroom in Penrith for that. So you choose. You tell me if it's not in a bubble, but it is. So it doesn't always go up. Whether the bubble bursts, well, that's up for debate when it's going to happen. But real estate just cannot go up continually because eventually the people in the country will not be able to afford it because wages don't rise at the same rate. So you got to be careful when you buy real estate. So again, getting back to what I'm talking about, I love real estate, but I don't like overpriced real estate. Why? Okay, so that's why it's sitting at B. But at different times, it might sit at A. Just quickly, if you're ready to take control of your finances but feel stuck on where to start, I have a solution. My book, Money Buys Happiness, simplifies investing and wealth building with practical steps to help you achieve financial peace. Get your copy via the link in the show notes and let's get your money working for you. Now back to the episode. Okay, moving on. We've got the next one, gold. One of the oldest currencies in the world, right? For thousands of years, gold has been a currency. But here's the thing with currencies. Currencies are a terrible investment. Why? Because you can only make money by selling it to a greater fool. There's no value in currencies. There's no value in fiat currency. There's no value in cryptocurrency, right? And the same thing, there's no real intrinsic value in gold, although it is better than crypto because it does actually have some utility. You can use gold to do different things, okay? Now, back in the before the 1970s, they actually had the currency attached to gold. It was called the gold standard. But when Nixon came in, he took the fiat currency, the US dollar, off the gold standard and inflated the currency, okay? Now I believe Elon and Trump are actually they're actually going to inspect Fort Knox right now, and they're going to try and tie the fiat currency, I think, back to the gold standard and delete the Fed. I'm pretty certain that's the objective they're going for, although I don't know them personally, so we'd have to ask them, but it looks to be like they're going to go back to the gold standard. So gold, for a long time, has been a reserve currency, so that's why it ranks higher than shitcoin on the actual chart, all right? So for the last 30 years, it's returned about 7.5% annually, which is actually a really good return. So you can see that it's been a very effective hedge against inflation, but it doesn't really create wealth because it doesn't produce anything. It's actually a non-productive asset. What do I mean by that? Well, let's talk to Warren Buffett, the greatest investor who's ever lived and the richest man in the world. So Warren Buffett explains it best. He says, Buffett said that he had no opinion on where gold might go. He said, the one thing I can tell you is it won't do anything between now and in the future except look at you. What does that mean? Well, here's an example. In contrast, stocks or businesses like Coca-Cola, Walmart, Wells Fargo, right, which are productive, they'll generate money and the value of the business will go up. So it's a lot better to have a goose that lays a golden egg than just have a goose that sits there and maybe goes up or down in value, okay? Because gold doesn't lay golden eggs. It just sits there exactly the same, right? As Warren Buffett explains it, all the gold in the world at this time is worth about $7 trillion. And by his calculations, that's equivalent in value to 1 billion acres of farmland in the United States, 7 ExxonMobil businesses, plus $1 trillion in just walking around money, right? So if you offered me the choice of a 67-foot cube of gold that will not change ever, or 1 billion acres of farmland that produces cotton, soybeans, crop, and 7 ExxonMobil businesses on top of that produces oil, and $1 trillion of walking around money, which one would you take? You wouldn't take the flipping block of gold. It doesn't produce anything. And this is why gold does not rank highly on the chart, okay? So let's move gold to where it really belongs, which is probably no higher than bonds. We're sitting it right there with bondy bonds. In fact, it's probably a little bit less. I'm going to stick it in between. It's going to get a D.5 right there on the chart, okay? Sorry, gold. You don't produce anything, okay? So we can't have financial independence if you have no cash flow. The only way to make money is to sell it to a greater fool. It also follows the greater fool theory, okay? All right. It only leaves a few left. So what's going to be the best? Stay tuned to the end because I'm going to show you the very best investment you can make. All right. Now, let's move on. One of my favorite investments of all time is this one. And of course, it is stocks. Historically, stocks for the last 30 years have returned around 10.97%, absolutely destroying inflation, which is wonderful. It returns more than gold, more than bonds, more than real estate, more than shitcoin, and more than term deposits, okay? So 10.97, if inflation 3 or 4%, it's absolutely smashing inflation. Now, that doesn't mean it's going to continue, but since the year 1957, the S&P 500, the top 500 companies in the world, which is the stocks, have actually returned around 10.26% on average every single year, on average. So history doesn't repeat, but it certainly rhymes. The reason why they're effective is because the businesses produce dividends to you so that you're actually getting some cash flow back for your investment. But also, as the businesses develop and grow in value, the price goes up of the stocks, okay? So as a business produces more profits, it becomes more valuable, and you can actually make a ton of money in stocks, all right? Stocks compound money like crazy. And this is how the wealthy grow their fortunes. Approximately 15% of global billionaires have amassed their wealth through finance and investments, which includes stock market activities. And if you look at Jeff Bezos, Mark Zuckerberg, Warren Buffett, Bill Gates, and so forth, they became wealthy because their businesses got so valuable, they listed them on the stock exchange and they held their stocks for a long time, all right? And that's how they've produced billions and billions and billions of dollars. I don't see anyone who owns crypto in the top 10, 20, 30, 40, 400 wealthiest people in the world, okay? So that's a sign. It tells me that we can't put crypto above stocks. We've got to put stocks way up here. Stocks, and think public businesses, all right? And I love stocks because I've put them higher than real estate because you don't have to look after it. You don't have to fix it up. You don't have to manage tenants. You don't have to worry about floods, fire, etc. Now, not all stocks are effective because not all businesses are effective. But if you hold a basket of stocks, say, in an index fund, you really minimize the risk of businesses going broke, which they can do, by having diversification, right? So it's a diversified group of stocks. And the facts are it has outperformed the other assets handsomely. It's not even up for debate, okay? Not up for debate. And I know what some of you are thinking, Lloyd, but real estate's got leverage. Yes, it does. But leverage also comes with risk because everyone in the last 10, 20 years, they've only ever seen real estate go up with leverage. But what if it goes down with leverage? Stay tuned for that. So leverage can amplify returns or amplify losses. So having a lot of leverage is not always good. It's only when the asset's going up. But what I love about stocks is that you don't need leverage, okay? The businesses will grow over time and your money with it. Now, let's look at the chart. So far, what we've got is we've got shitcoin at number F. We've got term deposits at D. We've got gold at like D.5, all right? Then we've got bonds at about C. We've got real estate at B, great asset class at the right time for the right reasons. And then, of course, we've got our illustrious stocks at A-class type assets. Wonderful. So we've still got a couple left. What could possibly be better than stocks? Check it out. We move into the next one. It's going to give away the first one, but that doesn't matter. All right. You're still going to guess, like, what is the first one? So we've got here private business, right? And if you look at private businesses, a lot of private businesses can return anywhere up to 40% per annum. Why is that? Because statistically, they're more risky because most people don't build their businesses beyond 5 years. In fact, 80% of businesses fail within 5 years or less. However, those people who select good businesses, have good business acumen, show up and get after it, this is where wealth actually comes from, unless it's inherited, which my friend calls it making money the old-fashioned way. But if you don't have an inheritance, how do you build wealth? You've got to get into your own business. All of the successful, wealthy people I know who are self-made, they got there through businesses. How we've made our money is through private businesses. We have 4 businesses. We've built 2. Actually, we've built 3, currently still building 3, but we've also just bought one. Okay, the one we just bought, before we bought it, we could see it was producing 40% returns a year. Okay, so it was very simple to see this is a good business. And that's how you can make a ton of money, way beyond inflation. Like, look at that, 40%. I know some businesses that make 95% margins. It's insane, right? But if you look at all the successful people in the world, again, Mark Zuckerberg, Jeff Bezos, even Warren Buffett in the early days, they all made their money from getting into business for themselves. Very few people build real wealth in some sort of like 9-to-5 scenario working for a big company. It's possible for sure because they can invest and they can look after their money. But the reality is getting into your own business is the way we can really amplify your wealth. And it also makes you a better person because it's a personal development program with a compensation plan attached, okay? Now, statistically, 69% of the Forbes 400 members, that's the top 400 wealthiest people in the world, 69%. In 2011, they said were self-made, having started their own business. And if you look at the other side of the list, 31% of the list in 2011, they came from wealthy families. So a lot of them inherited it, okay? But more of them built it themselves. And so that's why I rank private businesses personally way up at A.5. It's like way up here. It's actually better than stocks, right? Because if you don't have any money, how are you supposed to buy stocks? If you don't have any money, how are you supposed to buy real estate? If you want more money, you got to start a business, either on the side or get out of your job eventually and go all in to start a business. So A.5, it's right in the middle there, is private business. It's way up on the scale. So what does that leave last? What could possibly be better than having your own private business producing tons of return every single year? What could be better? What could be better? There is one thing left. The final asset, the most productive asset, the best hedge against inflation ever. Because without this, none of it can happen. This is the most important one. And of course, it is you. I know, how cliche does that sound? Sounds terrible. No, but it's you, right? You are the best asset. The skills you develop, the knowledge you gain, and the opportunities you create, and the connections you have can yield returns far beyond any asset class. When you invest in yourself, whether it's learning high-income skills, whether it's learning high-income business acumen, starting a business, mastering your money, learning about this stuff even, right? Connecting with new people, building relationships, it is limitless. The earning potential is limitless. How do I know that? Because look at Elon Musk. He's worth over $400 billion. And that came from him investing in himself. The knowledge, the teams he's built, the skills he's built. Without any of that, that wouldn't be possible. And he may very well be the first trillionaire. It looks like he's going to become a trillionaire. So think about that, right? It's not because he invested in real estate, bonds, gold, stocks, private business, whatever. Yes, he did build private businesses. So that's why they're A.5. But without investing in himself, reading the books he has, investing in his skills, his time, his relationships. Without that, he wouldn't have any of this, okay? But it does depend on your goals, but one thing is very clear. Ignoring yourself, your skills, and your ability to generate income means you're leaving the best investment untapped. That's where you got to start. Start there, and everything else will follow. So we've got to take you and move you to S, meaning superb, the perfect asset, the asset with unlimited returns. Will it hedge against inflation? Yes, it's the best hedge you can possibly have when it comes to beating inflation. How do you start? It means actually acquiring knowledge, deploying the knowledge into the field, developing your network, and exploiting opportunities and building skills, all right? And eventually, the money will catch up. All right, that's it for the best and worst investments. Hit the subscribe button if you enjoyed this. Leave me a comment below. What do you think about my chart? Would you put them in the same place? Which one is your favorite asset? Please leave your comments below, especially if you love shitcoin. All right, see you on the next episode, and I'll talk to you soon. Thanks for listening to Money Grows on Trees. If you enjoyed the episode, leave a 5-star review on Apple Podcasts and Spotify, and subscribe to us on YouTube so you never miss an episode. And if you're serious about building wealth, make sure to check out the links in the show notes and follow me on all social media platforms at Lloyd James Ross for more. See you in the next episode.